a couple of years ago, when you talked about the pace of the cord cutters and the people losing sort of, cable TV, you'd think we'd be at zero by now.
Right.
Did you find any, and of course, we're asking, we have a vested interest in this question, any reason for optimism that maybe that pace of decline on the ABC side, the ESPN side, is slowing?
Definitely. I think one of the key lessons from this particular earnings result is that the cable model, the old media world, is not imploding. They grew revenue 7%, and they did indicate a slight decline in subscribers to ESPN, but it must be very modest to be having those numbers. So that's not falling apart, which actually, to me makes it interesting. A lot of CEOs would look at these results and say, well, I don't know that we need to take this bet the company gamble to transform the model because it's really pretty stable. So, but I think they do have to make the change. They do have to pivot, and the streaming looking ahead is going to be incredibly important.
And that's important too for shareholders because we did the math earlier. I mean, it's very simple. ESPN Plus is $5. ESPN gets an average of $7 from a cable subscriber. They want $7, not $5.
Yeah, and a key thing there, remember, they get $7 from the cable subscriber, including many who don't even want it. It's in their bundle,
and
so they've got huge numbers. I've seen a lot of analysis of these numbers, and you've got to really get a premium price for that to equal the cable revenue. But look, there's a devoted base there. And again, I think when you separate out the people who really want it and will pay for it directly, they probably will pay quite a bit for this product.
There are comparisons, obviously, to Netflix in terms of the pie they're going after and what they need to spend. Is that misguided? Is that comparison not valid? Because they're not going after every single Netflix subscriber, so therefore the budget shouldn't have to be that much either, right?
No,
the assumption is that they're going to have to spend a whole lot in order to compete.
Well, they already spend billions on content.
Exactly, right.
Exactly. I mean, they already have most of their product. I mean, they are ramping up production. You are going to see higher expenses. They've been saying that. But the big money that they've spent, primarily for the, the premier sports franchises, those are sunk costs. I mean, they're already paying for those rights. They may have to renegotiate some of those contracts a little bit to deal with the streaming thing, but I agree. They're not going to have a lot of incremental cost. And I think the direct head-on-head composition with Amazon and Netflix is a little bit exaggerated. Disney has a very clearly defined market that so far Netflix and Amazon have not seriously targeted, particularly sports, to some extent, the family, children market. So they do have a very, very strong brands in that area, very strong consumer following, and they've locked up a lot of the rights to the premier events in there. So I don't see them really as head-to-head competitors.
You mentioned that, looking at the resilience of the traditional cable model, maybe they shouldn't have done this, but if they had sort of seemed like this exhibit A of innovator's dilemma and they're not going to move, they're going to milk the old business, they couldn't have changed the conversation, right?
No.
So now they get to say, look, we did this big Fox acquisition, we're doing this direct-to-consumer rollout. It's kind of messing up the traditional financials, but don't worry about it because we have a grand plan.
Yeah, I mean, I feel they had to do it, and I give them credit for doing that. I'm just saying I think some people probably wouldn't have, but they had to get ahead of it. They couldn't wait for the disaster to come to make a bold move like this. And, they had some modest losses. I give them credit for releasing the direct-to-consumer results. I think those losses are going to get bigger. There's going to be some investment here. This is very early. We don't know what kind of returns. I think ESPN Plus is really a pilot fish for the bigger operations. That's, so they've got 2 million subscribers. That's not a big number, really.
Feels like they're testing it. They're just kind of they're poking around. They want to see what works, right?
Yeah, and I think that's good because, one of the big concerns here is that Disney has never really been a technology company. They have not succeeded trying to get into the digital channels, particularly before now. What does Disney know about delivering content over the internet?
Well,
that was one of the
BAM Media, the MLB network, effectively.
Yeah, well, buying it is one thing, managing it and knowing what they do is another. I think that's been one of the big question marks. And I think if they can use ESPN Plus effectively, which Iger says, they've learned a lot and they're doing well, that is going to reassure people when the big leagues come along. They can pull that off.
FastPass works pretty well. They got those wristbands at the parks.
And now they got Star Wars, they've got the Marvel, and they can keep raising prices. Jim Stewart of the New York Times and Disney book author. Jim, thank you.